Afshen everyone, and welcome to the Economites, where we have candid conversations on critical issues. My name is Nyiko Mgiba, and this video aims to interpret a little bit about what we've been seeing lately in the financial markets in the context of the COVID-19 era. So what you've been seeing, if you've been paying attention to the markets, if you haven't, it's fine, let me just explain. So what we've been seeing is the stock market doing very, very well, but yet the real economy doing badly. Now what I'm going to do is I'm going to explain a little bit about how this thing can happen. Why does the stock market go that way and yet an economy can go that way? And I'm also going to go on and tell you what are the consequences should this continue for a sustained period of time. Enjoy.
Afshen everyone, and welcome to the Economites. Today's presentation is titled Economic and Market Performance Divergence in the COVID-19 Era. Now, to simplify things, the word divergence simply means a situation in which two things become different. Now, that's exactly what we've seen during this COVID-19 era. We've seen the economy do very, very badly, and yet the stock market has been doing very, very well. So that's what we are going to speak about. We're going to speak about some of the drivers and some of the possible reasons as to why this is happening. But before we get there, I asked two friends of mine, in fact. One is a sister from KZN. Her name is Cindy Magwaza. She will explain what an economy is. What do we mean when we talk about the economy and what drives an economy? And then another friend of mine from Zimbabwe, his name is Abraham, and he's basically going to define the stock market. So take it away, guys.
An economy is an ecosystem that is made up of trade, transactions, and exchanges of goods and services. Now, what drives an economy? Productivity, workforce growth, sales and investments, and consumption.
The financial market is a marketplace where creation and trading of different financial assets, such as company shares, debentures, bonds, currencies, and derivatives takes place. They serve as an epicenter of value segments as well as facilitating the allocation of resources to the larger economy to individuals that serve as wealth and income creation platforms.
Thank you so much, Cindy, and thank you so much, Abraham. Just to quickly summarize on what they said, the economy is a system that facilitates transactions, or rather it's made up of transactions, trade and other exchanges of goods and services. Notice how she didn't mention anything about geographical location. That's pretty important because that tells you that an economy can happen anywhere, as long as if there are transactions happening in that place, there's exchanges between goods and services, there is trade happening. As long as if that is happening, it doesn't matter whether it's informal, rural, or very formal, structured, and sophisticated and regulated. It doesn't matter. Both systems rather can be described as an economy, and this goes up all the way to the global economy, where they look at the sum of all the transactions that are happening all over the world. And then quickly going to the stock market. The stock market basically is a marketplace that facilitates the buyers and the sellers of securities and stock. So basically, stock is not just only limited to shares. I know whenever people think about the JSE, they always think about shares. It's more than that. There's also debt. There are companies that go and offer, they go to the JSE and other stock markets around the world and offer their debt to their public. And then what the public does, they buy the debt and then they sell it and they buy it amongst themselves. So this all happens in the stock market, and that's what essentially a stock market is. It's a marketplace where buyers and sellers meet and they trade these things. Okay. Now, in order for us to really understand the divergence, where the divergence comes from between an economy and a stock market, you have to look at the drivers. What drives an economy and what drives a stock market? If you can understand what drives the economy and what drives the stock market, then it will go a long way in you understanding that it can go in the different directions. Because an economy, if you look at what drives an economy, productivity, workforce growth, savings and investment, and consumption. Productivity means output and efficiency. The more stuff gets done, the more business deals are done, the more transactions are concluded, you're increasing output. And as a result, you're increasing your economic growth, workforce growth. That speaks directly to unemployment, which we'll have a look at later. Now, you can't have an instance where there's high unemployment and yet the economy is still flourishing and growing. Because if you have high unemployment, it means that you have less people being in positions where they can be productive. You see how it doesn't make sense. And savings and investment, how I always say it is that if you save money in a bank or in some sort of formal manner, formal structured, let's say for a bank, you are not only storing up money for your future self, which will be more because of interest, but you are making that money, which you don't need at the moment, available for someone else who needs it and could be productive with it. You see? And then with consumption, you're looking at, if you spend money, someone else is earning that money that you are spending. And they use it to be more productive in whatever service or good that they are giving you. So those are the drivers of the economy. And then the stock market, simply put, it's market forces. Supply and demand. That is what drives up the prices of the stock in that market. If there are more people that want to buy, let's say for example a share, than there are to sell, then the price will go up. If there are more people that want to sell the share than there are to buy, then the price goes down. So this tug of war between supply and demand, this is what drives the stock market. Okay, and also increased participation in this tug of war. The more people come in, the more they fight between supply and demand, buying and selling. This is what moves the price. So now let's quickly talk about the COVID-19 pandemic. It's been quite difficult to get data due to the lockdown, as Stats SA has been under lockdown and not much data has been coming out of anywhere recently. But they released this piece of data on the 14th of May, which I think is telling, because it looks at the COVID-19 consequences on workforce. And remember, we said that the workforce is a key driver of an economy. If you look at that 36 represents 36% of businesses which were surveyed that they are laying off staff, meaning that people are getting fired. People are being removed from the position where they could be productive. Another big number which you see is 28. That's decreased working hours, meaning that the people that are still in those positions are not as productive anymore. Another very telling number is the 1%. 1% of those companies, right? 1% of those companies are recruiting. Only 1% are recruiting, and 36% are firing. Meaning the net effect there is that there is decreased workforce growth. And then if you look at the decreased working hours compared to the increased working hours, the net effect there is that there is decreased productivity. You see, two fundamental things which drive an economy. Now you might be asking yourself, these are companies, and some of these companies are listed in the stock exchange. So how can they be less productive, but yet their share price still goes up? That's a very good question. We'll answer it now. So now this is what we're looking at the economy, right? The economy in the COVID-19 era, it's getting a beating. It is getting a severe beating. The longer the lockdown restrictions as a result of the COVID-19, the longer they are put in place, the more the economy suffers. Workforce, more people are going to lose jobs. More people are going to become less productive. Now, let's look at the JSE. With the JSE, it's quite interesting. The JSE All Share Index, which tracks the performance of the JSE. in the beginning of the lockdown, was around about March, there was a sharp decline because there was lots of uncertainty. And that's one thing which investors don't like, uncertainty. There was a sharp decline. But equally so, there was a sharp recovery. Now, this is where the divergence happens, because during the decline, it was quite similar to the economy. But now the recovery was so sharp, and the economy continued going down, and the stock market went up, shot up. In fact, it makes a V, like the letter V. That's how sharp it has. That's how sharp it has been. You see. Now you gotta ask yourself why. Why is this happening? These are some of the reasons. The first one, we said that it's the different drivers. So things like this can happen. Okay. Although it seems very counterintuitive, it really can happen if you look at what are the driving forces of these things. The stock market is more efficient. It's more efficient. And simply put is that stock reacts more quickly than an economy. What am I saying when I say that? Investors it can be people, it can be organizations, it can be households. You move quickly. Let's say, for example, if something happens in some part of the world that affects your company, you will move quickly. It's either you will buy or you will sell. And because the price depends on the buying and the selling, it will move immediately. Other than an economy, which we have to wait for economic data like unemployment, which takes quite a while. So fundamentally, the economy is it's more reactive, and the stock market is a little bit more proactive when it comes to pricing in information and data. Another example, I can see I'm pressed for time here. I'm going to speak about the fear of missing out. The fear of missing out. If you look at the previous financial crises, you would understand that those crises, as much as how there was a sharp decline, there was also a sharp incline and a sharp recovery. And as a result, now investors feel like this crisis is going to be the same as the other one, and they don't want to miss out on that sharp recovery. And what a good situation, what a good opportunity for them to catch that recovery while it's still at its low. So as a result, people are feeling more optimistic. They're saying that there's going to be a sharp recovery. So therefore, I should get in the market right now. I should buy right now. While things are cheap, I should buy. And more people do this, which shoots up the prices of stock. Okay. I hope that made sense. But if you still want more clarity, you can just engage with me. You can send us messages. So what does this all mean? If an economy which affects everybody is not performing well, but yet the stock market performs well and only a few people have access, or only a few people participate in that stock market, then you're going to get a situation where the poor get poorer and the rich get richer. Why? There's not a lot of people which have financial assets, which have shares, which have invested in bonds and debentures. But an economy, particularly a national economy, it affects everybody. So if an economy is not doing well, if the economy is not producing prosperity, but yet the stock market is going up, it means that those people with financial assets, those people with shares, those people with bonds and debentures will do well in the midst of the majority doing badly. This increases the gap of the rich and the poor. We're going to speak about the consequences of inequality, but what I can say that this is the real bad guy. I know in South Africa we always speak about the triple-headed dragon of poverty, unemployment, and inequality. Well, I'm of the opinion that inequality is the worst because of the fruits that inequality can yield and all the bad things that it can produce. This is what's going to happen. The gap is going to widen if the economy does not grow, but yet the stock market continues growing. Thank you so much.
Well, there you have it. Thank you so much for watching the video, and I hope you enjoyed it and you were enriched from it. For my parting shot, I'm going to leave you with this. During a time of extreme volatility and lots of irrational behavior, sometimes it might just be best for you to take a step back, get financial advice from your financial advisor before you execute. That way, you'll not only be protecting yourself, but you'll be placing yourself in a position where you can make the best decision. Thank you so much. Enjoy your day.